The semiconductor industry is right in the middle of an unprecedented AI-fueled explosion. I mean, the numbers we're seeing are just staggering. But at the same time, the whispers are getting louder. Is this incredible boom built on a foundation of sand? So today we're going to break down the data to see if we're witnessing a technological revolution or a bubble that's just about to pop. Okay, let's dive right in.
Okay, so first, let's just talk about the scale here. The global semiconductor industry is on a path to hit nearly $1 trillion in annual sales in 2026. That's right, $975 billion. This isn't just growth, it's a full-blown gold rush, and it's almost all driven by the insane demand for artificial intelligence. But right when you're trying to get your head around a number that big, in comes the reality check from financial analysts at the market ear. They're looking at this and seeing a market that's crowded with investors, stretched to its absolute limits, and yeah, maybe even running on fumes. And that right there is the central tension we're digging into. Absolutely massive, record-breaking numbers on one side, and these stark warnings of exhaustion on the other.
All right, so to really get what's going on, we have to start with the engine driving all of this. Let's talk about the AI chip gold rush.
Okay, look at this. What's crazy here is just the speed of this whole thing. The combined value of the top 10 chip companies has nearly tripled in just 2 years. I mean, it's shot up from $3.4 trillion to a mind-boggling $9.5 trillion. Yeah, this isn't some slow and steady climb. It's a rocket launch, and it's all being powered by the promise of AI. But here's where we start to see the first little crack in the foundation. That $9.5 trillion valuation, it isn't spread out evenly. Get this, a whopping 80% of that value, it's tied up in just 3 companies. Whenever you have that much value concentrated in so few hands, you create a really fragile situation. You know, one stumble from a leader could send shockwaves through the entire market.
Okay, so let's follow this thread because this concentration leads to something really weird. Underneath this entire boom is a seriously high-stakes paradox that kind of defines the whole industry right now.
So, by 2026, the forecast is that these super powerful, super expensive AI chips, they're going to bring in about half the industry's total revenue. We're talking almost $500 billion from just this one type of chip. Seems pretty balanced, right? 50-50. AI chips on one side, all the other chips on the other.
Okay, hold on, because this next part is going to give you whiplash. While those AI chips make up half the cash, they are less than 1% of the actual physical chips being made. Just let that sink in. More than 99% of what the industry actually makes, the chips in your car, your phone, all that stuff, is fighting for the other half of the money. The whole industry is basically balancing on the head of a pin.
And that brings us to the core concept here. It's what some are calling the high-margin, low-volume paradigm. It's a massive, massive bet. Basically, the industry's put all its eggs in one tiny, very specific, and very expensive basket. If demand for that tiny slice of the pie falters for any reason, the financial hit could be just enormous.
And you can already see the ripple effects of this. You know, there's only so much factory space, so it becomes a zero-sum game. Every bit of capacity that goes to making an AI chip is capacity that can't be used for something else. This is leading to shortages and huge price jumps for other critical parts, like memory chips for PCs and smartphones. And that's actually a huge reason why we're seeing forecasts for lower PC and smartphone sales.
So all of this strange internal stuff, it's making the financial markets pretty nervous. They're starting to send up some pretty clear warning flares.
Just look at this chart. Investors have been piling into semiconductor funds, ETFs, which are just baskets of these stocks. The amount of money flowing in has been huge. And this is exactly what analysts mean when they say a trade is crowded. It's like everyone's crammed onto one side of the boat, which, as you can imagine, can get pretty risky.
And all that buying, all that chasing, has pushed the sector deep into what's technically called an overbought danger zone. Now, sure, a stock can stay overbought for a while. That can happen. But the big warning here is that when these things finally do turn, it's usually not a gentle decline. It's often fast and furious. This quote really captures the feeling in the market right now. That frantic buying frenzy, the squeeze they call it, well, it's done its thing. The easy money's been made, and now we're left with this stretched, vulnerable market. And everyone's just waiting to see if there's enough real substance to keep it all propped up.
And it's not just the internal industry risks or the market jitters. There are also some big storm clouds gathering on the outside.
First up, a classic economic threat. Oil prices are on the rise.
An oil shock just throws a wrench into everything. It hurts consumers, it raises costs for businesses, and it creates a ton of uncertainty. This is the kind of thing that can really derail a market rally, and the tech sector is not immune. It's a major headwind that, frankly, nobody was really talking about just a little while ago.
And then, beyond the big picture economy, you've got these really fundamental business risks. First off, the return on investment. Are the trillions being poured into these AI data centers actually going to pay off? That's a huge question mark. Then there's the power grid. Can it even handle this? We're talking about needing an extra 92 gigawatts by 2027 just for AI. And what about innovation itself? Could a new, more efficient chip come out tomorrow and make today's super expensive hardware basically worthless? And finally, price wars. When you have profit margins this high, you're painting a giant target on your back. Competition is coming, and that could crush those profits.
Okay, so with all these moving parts, all this complexity, what should you actually be watching to see how this all shakes out? What are the signposts we should look for?
Well, here are 4 big things to keep on your radar. First, competition. Can the big dogs hold on to their massive lead, or is someone else going to come in and take a bite? Second, the memory market. Are we going to see manufacturers get carried away, build too much capacity, and set us up for another one of those classic boom and bust cycles? Third, and this is a huge one, power. Is there literally enough electricity to power all these new data centers? And finally, geopolitics. What happens as more countries try to bring chip manufacturing back home? How does that change the game for everyone?
And all of that brings us back to the big final question. Look, there's no doubt the AI revolution is here. It's real. But what we've seen is that it's being built on this foundation that is, well, it's incredibly lopsided, it's paradoxical, and it's facing threats from pretty much every direction. So the real trillion-dollar question is that foundation about to crack?